Often called a T form. This is the bank's balance sheet in a very simplified form. Now, obviously, any bank you look at, even a small town local bank, but definitely some of the larger international banks are going to have more complicated looking balance sheets with more detail. For instance, they're going to want to group their loans into different types of loans, different risks, and uh, different loans, business loans versus mortgages, etc. But that's way too much detail for an introduction to the bank balance sheet. So we're looking at this is kind of a bird's eye view overview, very simplified form of what a bank's balance sheet is supposed to look like. So on this balance sheet, one of the first things that you need to know, and this is for exam purposes, you're going to need to know what the assets are and what the liabilities are. You don't necessarily need to know why, but it's useful, as I've pointed out many times, it's useful to know why in order to memorize. Once we have an understanding of the logic behind things, we can, if we don't remember what we're trying to remember, we can just derive it from the other information we have. So, why is a loan an asset and a deposit is a liability? That seems a little backwards at first blush. Think of a deposit and think of how badly banks want you to deposit their money. I remember reading one cartoon in one econ book we worked out of at CSU where somebody made a deposit and the teller just gushed at just saying thank you for this deposit. They like it when you deposit money. They really do. It's because obviously they want money to go and earn interest for them. So if you're depositing money into the bank, why is it that the bank considers that a liability? Liability is a bad word. And if it's such a dang liability, wouldn't banks want to just not have any deposits? Well, that's not exactly how we're understanding assets and liabilities. Instead, we're looking in a more neutral way at the two words, where liability is something that could potentially be a problem. It isn't necessarily a problem, but it could potentially be one. That's a correct normal person understanding of liability as well as the way an economist would understand it here. And an asset is also not necessarily something that is absolutely going to be valuable, but it's something that is, if you're going to classify it as anything, you're classifying it as something that's valuable. So think of a loan. This doesn't make a whole lot. These make sense, securities and reserves, and we'll get into what those are and why they do. But a loan you give out, you have $1 million, somebody wanted to borrow $1 million. So you lent it out. How sweet of you. Not necessarily sweet when people find out about all the fees and the interest you're charging, but they'll still be happy that they got the loan they were looking for as long as everyone was transparent about what they were doing. But you had $1 million and now you don't have $1 million because you lent it out to somebody. Hopefully they're going to pay it back. And if they do pay it back, 30 years from now or so, you're going to be sitting pretty. Now, banks will oftentimes get 30-year loans back within a few years. When people refinance, that means that whoever initially lent them money gets paid up, the whole thing is paid off, and they get to move on. And now you owe somebody else money, but the terms of the contract are perhaps a little bit better, which is why it's in your interest to refinance if you do. That's why people would refinance. So, but if you don't refinance, and a lot of people do take the full 30 years to pay back a 30-year loan or the full 15 years to pay back a 15-year loan, that's a long time to wait to get your money back. And of course, when you get your money back, you're getting it back with some interest, but then inflation eats away at that interest. So this is obviously something that could become a problem for a bank. Obviously, banks have a certain number of their loans default. And when a loan defaults, the bank, of course, loses a lot of money on that loan, which is why they want to be careful about who they lend money out to. And we did cover this in earlier videos where pooling helps to protect banks from that risk. If only one or two loans go south, but the rest of them are fine, then banks are fine. But it's still a problem if the loan defaults. Yes, the banks can foreclose on your home, and when they foreclose on the home, they can sell the home. but they're usually not going to be able to sell the home for as much as they got in as much as they're owed in the contract, as much as they lent out. They're still generally taking a loss on those deals because they can't force anybody to buy the home for a certain amount. And if you know that a bank is selling a foreclosed property, then you know that they're a little more desperate to sell than you may be to buy. So you can go bargain shopping. Banks know that. So they know that if they really try to bargain hard, they don't want to hang on to those homes. There are costs involved with maintaining them and so on. That doesn't mean that you should jump at any of these ads that try to teach you to buy foreclosures that are really, really cheap. They usually aren't that far below the market value of the home, but it is still something that is ultimately a loss for a bank when they sell the foreclosure. So it's a problem when the loan doesn't pay up. So to have this in the asset column seems a little off, just like saying that it's a liability. When you put cash in the bank has your cash. Shouldn't that be an asset, not a liability? Well, let's start with the deposits. Why is this a liability? Well, because your deposit doesn't stay in the bank. They don't hang on to that cash. They hang on to some of it, but they don't want to hang on to all of it. They want to lend it out, or at least put it in something that's going to earn some interest. The reserves are the asset. When we think that this is an asset, what we're really thinking about is this part here, the reserves. The reserves are an asset. That's cash that banks have, that anything they need to pay for, they can pay for it with that cash that they have on hand. This is a liability because when the money goes into the bank, as soon as they can, they're going to find a good deal that someone's looking for a loan, and they know that they're going to get their money paid back with interest. They want to lend it out here, or they at least want to get interest from one of these. So they're going to put it into one of these two things. And when they do, what happens is that money flies right out of the bank. The bank doesn't have the money anymore. Somebody else has it. And as we covered with the why we shouldn't be afraid about China owning all of our debt, banks have no way of going and getting that money back. They can't go to the people they lent it to and said, sorry. People who deposited the money, they want it back. So can you give me the money back? Obviously, people are going to say, no. I didn't get that loan so that I could make a pillow stuffed with cash instead of feathers. I got that loan so I could buy a home. I have the house now. Well, you want me to sell the house just to give you money back? And where am I going to live? I don't have my old apartment anymore. No, I'm sorry. I don't have the money. You want it back? Tough. I don't have it. So your deposit leaves the bank. And it's a liability because what if you come back and say, hey, I need that money back. I forgot about a bill I had to pay. Oops, sorry, sue me. Actually, you can't because you have to give me my money back when I deposit it. Nana boo-boo. So this is a liability because as we saw in the It's a Wonderful Life clip, they didn't have cash on hand in part because they had to pay back a larger bank that had lent them money. And I guess they made an arrangement where the bank could come looking for the money that was owed and they had to give it or else. I don't know if something like that exists, but why did they do that? That's on them, but let's not, whatever. The point is that even if the bank hadn't looked to get all their money out, if all the people rushing into the building and loan looking for their money back, there wouldn't have been enough. And that was a problem. It's a problem if your customers come in, they expect their money to be safe, and you don't have it. That, for obvious reasons, that's a problem. So this is a liability because at any given time, banks may have more people looking to withdraw their money than they thought they were going to have, which will put them in a place where they don't have enough in reserve to pay it. So it's a liability because there's that risk that follows banks around every day. Now, as we get further into how banking works, we'll see how there are a lot of things that are done to handle these risks, especially when we get into the Federal Reserve System and why they operate the way they do and how it is that they actually do stabilize our financial system. But either way, we have those safeguards in place not because we can use them all day, every week, every month, every year, and we'll be fine. We have them in place so if that once in a blue moon thing happens where banks always want to make sure they have in reserve as much as customers are going to want on any given day. But they might they might underestimate how much they're going to need to give to customers when customers come looking for cash. So those safeguards are there so that banks can handle it without having a run on a bank or having to shut down or anything like that if they need to. So this is a liability because of the perpetual problem that it represents for banks. These deposits, the vast majority of them, remember, fractional banking, the vast majority of this money banks don't have. They can't give you your money back if you ask for all of it, if everybody asks for all of it. One person asks for all of it, sure, but if everybody asks for all of it, they just don't have it. So that's why we put it in the liability column. And so loans are in the asset column because these generate money from banks. This is how banks make their money. Yeah, they might have to wait 30 years for some loans to get paid back in full, but they're still going to end up with fees and interest and everything with a lot more money than they lent out in the first place. And you add all those loans together, all of these deposits that they received, the majority of those deposits turned into something like these that earn interest, and then that interest comes in. But what if people don't pay up? Well, that happens, but banks tend to try to be careful enough so that most of that money is going to come in. Again, you can have an asset that depreciates in value, but until it defaults, it's a loan in good standing. It's an asset because while this represents money that is going to go away if somebody wants to make a withdrawal, this here represents money that's coming in. You made the loan, but that money is just coming in all the time as people make their payments. It's coming into the bank. The bank is generating new money from this that they didn't have before, even after the deposit was made. But then there's another thing that makes this an asset, and that is, like any asset, you can sell it. You can sell a loan that you made to somebody. When you make a contract, you own the right to a certain amount of money coming in over time. And you can sell that right to somebody else. That's what you may have heard in the wake of 2008 about mortgage-backed securities. And a lot of people think that mortgage-backed securities are a bad thing because of their role in the 2008 crisis, which we'll get into. But they're actually not a bad thing. They've been around just about as long as banking has been around. They're not a new thing. In fact, they're something that is used to stabilize banks. It's a very common practice still to this day for banks to take some of these mortgages that they gave out and to sell them for whatever reason. Hey, I need money now. I have these assets. You think about, you're an investor with extra money. You want to do something with it. You don't want to screen people who want to get loans or anything like that. But it is possible to go to banks, and some of that money that makes banks so rich, at least we perceive that they're rich, you can get you some of that money. You can tap into that income stream if you give banks enough money to buy at least a piece of this. And we also heard during 2008 that a lot of mortgage-backed securities were separated, where a lot of people had a certain percentage of a right to the money that was coming in as people paid their mortgage. So when people make their mortgage payments, the bank gets that money, but the bank can sell that right to you if you are an investor in mortgage-backed securities, and you can get those mortgage payments that are coming in over time. Of course, you also have to eat some of the risk. If it defaults, then you get a percentage of the sale of the foreclosure and you might lose some money. There's risk to every investment, but that's something that banks do in order to handle the problem we talked about how they lend long and borrow short. So they're on the hook. They're basically borrowing from customer departments and then lending it out. But they have to give this back maybe in another day or two whenever people come knocking and looking for their money. This takes a long time to come back. But the reason people like Larry Kotlikoff are maybe a little overly dramatic about saying he's the economist, remember, who at least introduced me to the term. I've never met the guy, but just reading him, he introduced me to the term lending long, borrowing short is why, not the term, but that's why he saw banks as fundamentally unsafe. Some economists do. It's a little overly dramatic to say that because banks can just sell these, and so they're not lending long anymore. They sell off these mortgages in the form of mortgage-backed securities. They get their cash if they need to raise cash. They don't want to do it unless there's a better opportunity that comes along. Maybe interest rates rose and they like to generate cash to make loans to people seeking loans even with higher interest rates. That might be a reason they do it, but it's an option they have. So because this is cash coming in and it's something of value that they can sell, this absolutely does belong in the asset column. In the next videos, we'll get into the rest of this and then play around with the balance sheet a little bit.